Did you know the average return on a high yield savings account is about 0.5 to 4%, while the S&P 500 has historically returned 10% annually? So why are so many people playing it safe with high yield savings accounts while leaving potential savings on the table? Let's dive into the trade-off. Welcome back to Simply Money, where we break down complex financial decisions into easy to understand insights. Today, we're comparing two major options for saving and investing your money: high yield savings accounts, or HYSAs, and the S&P 500 index. Both have their perks, but which one will help you build wealth faster? Let's find out. Here's the dilemma. Many people face a choice between comfort of safe savings or the potentially higher returns of stock market investing. On one hand, you have high yield savings, offering safety, liquidity, and little to no risk. But on the other hand, you have the S&P 500, a historically solid performer with the potential for much higher long-term returns, but also with more risk. How do you decide? Let's start by looking at the numbers. High yield savings accounts over the last few years, rates have hovered around 0.5% and up to 4%, depending on where you look. But right now, some of the top options are, in the 4 to 4.5% range, which is great for short-term saving, emergency funds, and avoiding market volatility. But when you factor in inflation, which is often 2 to 3% or more, as we know, your real returns could be zero or even negative. On the flip side, the S&P 500 has historically returned 10% annually over long term, despite its ups and downs. Of course, it's notwithstanding risk. There are bear markets, downturns, and volatility. But over a 10-year period or more, the S&P 500 has outpaced high-yield savings by a significant margin. The key difference here is time. The S&P 500 requires patience and a long-term outlook, while high-yield savings accounts are ideal for short-term goals and easy access to your money. Now let's break down what happens long-term when you consistently play it safe. We're going to look at a chart here to really give us a better understanding of what's actually happening. We're going to look at a scenario, as you can see right here, SPY. We're going to pretend in this scenario that we invested on March 1st, 2017, an initial investment of $50,000. We're also going to look here at comparing it to a $50,000 investment at a 4% interest rate in a high-yield savings account. We're going to look at what happens short-term versus long-term. Now, with the S&P 500, we're reinvesting dividends because this is just an investment scenario. We're not looking at living off of it, just like we're not looking at living off the interest of the high-yield savings. We're looking at them as pure investment and growth opportunities. So we broke this down quarterly because that's when the dividends are paid, and we're comparing that growth with the high-yield savings account. As you can see here, let's look at the first month that this took place. We got a dividend share of $1. The dividend payment was $216. Where over here, the interest earned was $500. So automatically people will be like, oh, see, it's safe and I did better. And what I did here is I put whether the high yield savings account, if it's in green, it means it's doing better than the S&P 500. If it's in red, it means it's doing worse. So after, 17 days, we have one time where it's doing better. So we're going to skip down here to December 21st, 2018, about a year and 3 quarters. You can see we've continued to get dividend payments. And you can see here that the $50,000 has only grown to $52,000. Look what happened right before this. Back in September, it was up to $63,000, but there was a market downturn in 2018, right at this time, and it dropped down to $52,000. So every quarter since it's been down, it got down almost $10,000 right here, right before where we're looking. But then all of a sudden, the high yield savings is doing better, only by about $2,600. It's not a big difference, but there is a difference by keeping it in the high yield savings. See, here's where people want that safety. Look, it's just going up, never goes down, it just goes up. It goes up a little bit consistently. Where the S&P 500, we see a big jump, it keeps going up. Oh, then we have a big dip. Skip down here to March of 2020, COVID. As we're looking at the S&P, you can see that now we got up all the way to 71,000 compared to 56,000 in the high yield savings. But then we had COVID and it dropped drastically, a $21,000 drop on this portfolio. Where the quarter before you were up $15,000 compared to your high yield savings, now you're down almost $6,000. Here's where time makes a difference in the S&P 500. This will be the last time that the high yield savings account actually is doing better because the short-term drops that it experiences keep getting less impactful. And we're going to skip down here to 2022, where we have another significant drop. June of 2022, we can see that the S&P got up to 104, then dropped a little bit to 102. Now we're at $43,000 compared to the high yield savings. You see, these drops are what make people want that safety. There were 3 of them. Now that we're seeing more time go by, the gains the S&P 500 have are more significant. So even here, when we have a significant drop of $17,000, we're still up compared to a high yield savings. So let's just imagine you're invested in the S&P 500 in this scenario in 2017. You rode through a couple downturns, and then all of a sudden you get to this 2022 when the market's really turning down. And you look at your portfolio and you go, oh my gosh, I'm down $17,000. I knew I should have kept it into a high yield savings where it was safe. Well, if you'd kept it in the high yield savings, you would still be going up, but you'd be down $23,000 compared to what you would have been in the S&P 500. So even though you're feeling that negative drop, the market fluctuations, the volatility, you're still up $23,000 compared to if you played it safe. Let's go down to March of 2025. Now we're getting into a longer term. You're looking at 8 years have passed. And again, we have some downturns here, some minor downturns. But at the end of March of 2025, you would have been up to $137,000 with the S&P 500. And if you played it safe in the high yield savings, you would have lost out on $67,000. Now, if you're putting your emergency fund somewhere, the high yield savings account is where you need it. Because if you needed your high yield savings account right here in 2020 during COVID, maybe you lost a job, maybe you needed to dig into some of that emergency fund, you would have had to sell out while it was down, and that would have impacted that even more. But here, you're consistently in the high yield savings account building and going up, and you don't have to worry about being down when you need it. But if you're looking at investing for long term, for retirement, for independence, the high yield savings account isn't even keeping up with inflation. And look at what you've lost. You've lost $67,000, almost $68,000 as of March 21st, 2025. Now, by the time you're watching this, we've gone through some more really hard downturns as announcements of tariffs crashed the market quickly and have gone back up some and then back down. It's been very volatile over the last couple weeks and couple months since this video was being produced. But I want you to realize that even now, if you put in the stock price, as we're doing this video, the stock price, we show it on March 21st at $570. Just plug in what the stock price is currently. That's not counting that you would have been adding more shares. Just put in the stock price what it is currently with this many shares at 240.4 shares and see what your total would be. It won't be $137,000 depending when you do this because the market may be down. It could be down to $550. It could be down to $500. But I guarantee you, unless the market has gone belly up, and if we're at a place where you're lower than this, we have to ride it out. I guarantee you that this amount here is still higher than this amount here. This S&P 500, I guarantee you, is still higher than the high yield savings. And this is only 8 years. When I'm talking about investing with people, I'm talking 10 plus years, 15, 20, 30 years time frames. This becomes astronomical. If we were to run this back for an entire 30-year investing period and someone played it safe and they put their money in a high yield savings account at 4%, and you have to remember there's been times you would have been begging to get 4%. You may have got 0.5%. But even if I give you the benefit of the doubt that you could get 4% in a safe CD or high yield savings account for 30 years, and you did the same thing, you would have some major ups and downs over here with the S&P 500. You'd have the dot-com bubble. You'd have the housing market crash. We had, as we saw here, COVID. We have all these different volatile moments, but this amount would be so much higher than that because the longer time frame you have, the more important this investment becomes into the S&P 500. Don't allow the fear to keep you from seeing the growth potential that you can have. Pause that chart and really look at those ups and downs and see what you're losing by investing or playing it safe. Again, I'm not talking about your emergency fund or money that you need in the short term. I'm talking about long-term investments. You're playing it too safe and you're losing out on hundreds of thousands of dollars. In the end, it's about understanding your goals and your tolerance for risk. High-yield savings accounts are safety, but limited growth, where the S&P 500 can offer much higher returns, but it requires a long-term commitment and the ability to weather market storms. So where do you fall? The right choice depends on your financial goals and time frame. What's your go-to savings strategy? Do you prioritize safety with high-yield savings, or are you more comfortable taking on more risk with the stock market? Drop a comment down below and share your thoughts. If you like this video, hit that like and subscribe button. Don't forget to hit the bell to be notified of future videos being launched. And we appreciate you being with us here on Simply Money, and we'll see you next time.